Hello and welcome to Portfolio Matters Weekly Update, Week 43. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So Keith, what do we have in today's episode?
Thank you, Richard. It's another packed episode this week. We have a lot of charts. Now, the big news was the UK budget.
Thank you, Keith. So the UK budget lowlights. So it's freezing personal allowances, rising the living wage to by 6.6% to £9.50. Come back to that in a moment. Rising the minimum wage for 21 to 22-year-olds, £9.18. Nearly 10% increase. No change to pensions tax. No change to CGT. 4% property developer tax to fund replacement of flammable cladding. But I think the key takeaway for me was that if you are, let's say, a professional couple with earnings of maybe £120,000 between you, your tax is probably going to go up by about £1,500 per year, which is effectively another 1% increase in your cost of living over and above the increases in cost of living we're already seeing. And I also think on the other side of the coin, I think if you're living in London and you're earning £10 an hour, you can't afford to live. And we've got these very big distortions in the labour market, which need to be rectified. What do you think, Keith?
Well, the freeze in personal allowances is another great stealth tax, because when you have inflation running at 4.5% in the UK, then essentially the tax thresholds have fallen and you're pushing people into the higher tax threshold. And also you're having these rises in the minimum wages, which will be passed on, which is quite inflationary. I mean, the rise in the minimum wage for 21 to 22-year-olds is up the best part of 10%.
Yep, I think that's right. So I think the jury is out on the Chancellor in a very difficult position. Clearly the country's finances were severely damaged by COVID. He's in a very difficult position, but he's moving in a direction that is not typical for a Conservative government, which is the state, I think, is now going to be about 41 to 42% of GDP, which I think is bordering on the point where the economy seriously suffers from state intervention. And we know that the state allocation of money is, generally speaking, not good.
Well, the trouble is, Richard, I think he is trapped in that we have an increasingly elderly population. And I think the elderly voters will vote themselves social care. And so you have this structural problem where the increasing part of the budget will be spent on medical and social care for the majority of voters. And the other thing I'd say is one of the surprising event this week was the fall in UK gilts as the Chancellor revised down the amount of expected borrowing. And that is really interesting. We'll go into it later, but it suggests what the market is concerned about was actually UK solvency rather than inflation. So
Keith, would you like to take us through the data for this month?
Yep, so we had, actually there were relatively light data week. So we had some good numbers out in the US from the IHS market purchasing managers indices. So we had October numbers for the composite, and that was 57.3, up from September and well above consensus. And that is really reassuring because those are October numbers, and they show that actually the US economy is being resilient to supply chain disruptions and to the spike in energy prices. And if you look at the services PMI, that rose strongly from 58.2 from 54.9 in September and beat expectations. The manufacturing only fell slightly to 58.2, down from 60.7 in September and missing expectations. But given the supply chain disruptions, I think that's a very respectable number. And the US Dallas Fed manufacturing index in October actually rose to 14.6 from 4.6 in September. So that's a big rise and massively beat expectations. All of that is really positive. At the Case-Shiller house price index for October in the US, and that was amazing, up 19.7%, which is consistent with the 20% rise in September. So US house prices have done incredibly well last year on very low interest rates and recovering economy. And previously we have talked about how house prices are essentially a function of low interest rates. And with interest rates now rising, you would expect house price inflation to really slow down. Now, in Germany, we had the IFO Current Conditions Index, which was resilient and again, really reassuring. This is on October. And so it was 100.1, which is down a tiny bit from September, but above expectations. And it shows that Germany is also resilient to rising inflation, rising energy prices, and supply chain disruptions. So all that's very reassuring. Now, we had flash German inflation numbers, and they rose again. So the October number was 4.5% year on year, and that's up from 4.1% in September, and again beat expectations. So German inflation is continuing to rise. Now, industrial sentiment in the EU rose to 14.2%, up from 14.1% in September, and massively beat expectations. And the other number was UK car production, which was terrible. In September, it was down 41.5% year on year, and that's down from minus 27% in August and massively missed expectations. And so the UK is really suffering from supply chain disruptions, both chip shortages and the shortage of HGV drivers. We also had some GDP numbers, quarterly GDP numbers from the US, and Q3 GDP slowed massively to only 2%. That's year-on-year numbers in Q3, which is down from 6.7% in Q2, and was a big miss on expectations, and the expectations were for 2.7%. But the price index slowed to only 5.7% year-on-year from 6% in Q2, and that was lower than expectations. So inflation coming in slightly lower than expectations, but still a very substantial 5.7%.
I'm just going to make a comment on expectations, Keith. I mean, had you looked at this, the expectations are basically some sort of fictional artifact, aren't they? Because the expectations months ago was that the inflation was going to be like 2.5%, and then basically what the expectations do is they take the last figure and add a little bit or take a little bit off. It's a meaningless, in my view. I might be being overly cynical here, but it's pretty meaningless, other than the fact that if something beats or misses expectations in this sense, the market reacts and the algorithms jump in.
Yeah, well, it's meant to be from bank analysts, Richard. So
economic update charts. So these are the charts that really reflect what Keith has just been talking about. So the US composite PMI has ticked up a little bit, and that shows some resilience. The US services PMI is doing the same thing. The manufacturing PMI also ticking up.
Yeah, all of which is very reassuring, I think.
Yes, and the Dallas Fed manufacturing index also ticking up. And the Case-Shiller house price index, as Keith said, is basically been leaping ahead. And presumably, if interest rate expectations are going up, then that index is going to start to fall away.
Well, that's some of the highest house price inflation year on year ever seen, frankly.
Keith.
And this is the German current conditions index. And given that current conditions are really quite bad, given you've got rising inflation, supply chain difficulties, and energy price spikes, then I think it's quite reassuring that it hasn't come right back off.
Yeah. German inflation is still in a steep upward trajectory, no sign of any pullback yet. And I don't think any of the conditions that we believe exist that are causing inflation have relieved to any significant extent. So my view is that is the inflation in Europe and the US and the UK is still on an upward path. Keith.
Well, EU industrial sentiment remains strong, which is very reassuring. And services sentiment actually picked up. So it rose to 18.2 in October, 15.2 in September. Sorry, these numbers were missing from the table, but that's very reassuring. It shows that services are picking up in the EU, and obviously services are the majority of the economy. And this is US GDP growth, which slowed markedly in Q3.
US continuing jobless claims have dropped again. Obviously, this graph isn't based at 0, it's based at 2.2 million. So you get a slightly distortionary view when you just look at the absolute height of the bars. But again, it shows the US job market is healing really quite rapidly. It seems to be accelerating now. So Inflation Watch, our favourite subject. Keith, you want to take us through this table?
Well, the only new number this week was German CPI inflation, which came in at 4.5%. We haven't got core CPI yet for Germany, but again, that was a step up from 4.1, as we've just covered. And Christine Lagarde has talked about not removing QE.
Christine Lagarde is trapped. She can't remove QE because the ECB buys so much government debt in Europe. And if you remove QE, government interest rates would soar and governments would go bust and there'd be another EU financial crisis. So she has to print her way out of the financial crisis, which historically isn't terribly effective.
And I noticed that the German member of the ECB board has resigned this week because he's fed up being the lone conservative voice arguing against QE. And actually, we will go on later to show you the bond spreads between the periphery nations and Germany, and Greek yields are starting to rise, so something to watch.
So here we have the continuous money printing of the ECB. Basically, it's doubled in a little bit over a year and a half. And it can't stop, I don't think. I personally don't think it can stop. So I don't know what the outcome is either.
What's notable on that chart is that the pace of QE is not slowing down.
Yeah. Eurozone PMI price pressures are continuing to rise, and supply chain disruptions continuing to depress activity. And the price pressures just looks extraordinary. If it looks so out of kilter over the last 20 years. with that one wonders to what extent it's going to have some very serious repercussions. German wage deals. So this chart shows what's settled versus what's demanded, and the settlements are significantly lower than what's demanded in a number of cases, particularly meat processing. But we do know that as price pressures increase, there will be more active demands by workers to increase their wages. And I did see that labour force activism is increasing. Is an article I read in the Financial Times this week, which bodes poorly for industrial action and labour price increases.
Yeah, well, we know that there are more job openings than job seekers in a lot of countries, and workers have pricing power. And frankly, the big question is, how much are they going to use it? And on that note, the blue line is the previous trajectory of US earnings, and the black line is what's happened recently. And you'll see there seems to have been a structural break, and earnings are now rising much more quickly than they were prior to the COVID crisis. So we are seeing that is real wage price spiral in action.
So a US core CPI has surprised by the most ever so far this year, which presumably means that analysts' expectations have underestimated what the monthly figures are going to be. And as Keith has put at the side here, well, perhaps, but who has it surprised?
Yes, well, the central banks have been relentlessly talking down inflation, and they would purport to have been very surprised by the big spike in inflation figures. But on this podcast, we haven't been. When we talked earlier about pricing power of workers, I mean, the thing is, the jobs market is tight, but it shouldn't be, because there are still a lot of people out of work. So these lines all show the employment ratios by sector, essentially. So before with zero being just before COVID. And you'll see that total employment, according to, by ethnic origin, remains much lower than pre-COVID. So a lot of people seem to just not have left the workforce currently.
And supply chain disruption continuing to drive inflation. So the Mannheim Used Vehicle Value Index just hit a new high. And apparently in the UK, if you wish to put in if you want to buy a transit van, a new transit van, there's a lead time of around about a year. And that has pushed up used transit van prices above the cost of a new one, because there is a shortage. And it's just an extraordinary distortion. Yeah.
And well, we saw that UK car manufacturing is down best part of 50% year on year. So these supply chain problems are causing inflation, and it will be persistent. This shows the difference between the 30-year and the 5-year, and that has gone negative. So markets are expecting less inflation over the 30-year period than over the 5-year period. So they are buying the narrative that this burst of inflation will be transitory.
We shall see. My view is that it is sustained, as this chart shows. Unilever is experiencing sustained inflationary pressure. Keith, this came from one of our Discord members.
Yes, this came from Richard Wilk, a Discord member who actually attended the Unilever earnings presentation. And so this is their input prices, what they're experiencing. If you move on to the next one, Richard, they are trying to pass on all those costs. So this is the growth of their output prices, and seeing they're growing 4.1% in Q3.
And emerging market food prices are higher than in 2011, which of course is when we had things like the Arab Spring and when the Chinese government, I think, was extremely concerned about social unrest because of rising food prices. And the dollar strength has hit emerging market food prices badly. Obviously, their currencies have depreciated against the dollar, and a lot of food is priced in dollars, commodities priced in dollars. And that is a recipe for social unrest. Moving on to UK equities. Keith, what is this chart showing us?
Well, this is very interesting, actually. And this is a chart from the FT, and it shows cumulative outflows from UK equities over the course of the last 5 years, i.e. since the Brexit vote. And what you can see is there have been net outflows every year, including this year.
So people aren't keen on investing in the UK market.
No. And as a consequence, if you move to the next chart, Richard, this is the cyclically adjusted PE ratio of all the equity markets in the world. And you will see that the UK is 8th from bottom.
Yeah.
So it is wedged between Thailand and Colombia.
And this could explain partially why the FTSE index has really done nothing for 4 or 5 years.
Yeah. Yes, basically.
If we achieve a revaluation, then we will be valued at the rate of Denmark and the FTSE will triple.
Well, you wonder how much worse it can get, you know, when we are valued on the same PE ratio as essentially Peru, Thailand, and Colombia and Chile. You know, there aren't that many countries below us. And so as a result, if you look at the PE ratio of the FTSE 100 relative to the rest of the world, we have a discount of 5, essentially. So if the rest of the world is trading on 18, we'd be trading on 13. So
there is scope. There is scope for a revaluation if the economy proves resilient to Brexit and all the other tribulations. But that is some way off discovering whether that is the case.
Yes, absolutely.
So Keith, you did this little section on the UK Help to Buy scheme and new build homes. You want to take us through it?
Yes, now this is interesting. There's some charts from the FT about the UK Help to Buy scheme. Now, what is the UK Help to Buy scheme? Well, it aims to help first-time buyers purchase a home, and if they have a 5% deposit. And so the state will then lend them interest-free up to 20% of the purchase price outside London and up to 40% of the purchase price in London for 5 years. So interest-free for 5 years. The scheme started in 2013 and it's been meant to expire several times, but obviously the house builders love it and lobby government to keep it going. So it's now due to expire in 2023 and we will see whether it does. And it's been a bonanza for UK house builders. And about a third of new build properties in the UK are funded through the Help to Buy scheme. But what gets really interesting is when you look at the price performance of new build homes, including new build flats. And so on the left here, we have a chart showing that traditional mortgage lenders are increasingly wary of lending to new build homes. So they are happy to lend 85% loan to value for existing homes, which is the red line, but less so to new builds. But on the right, what's really interesting is that new build homes command a sizable premium to old homes of the same size and type. And according to the Office of National Statistics, that premium is about 25%. Now, in theory, they should command a premium because new build homes don't need refurbishing and should be pristine. But as we know from various scandals in the UK, that is rarely true. And from personal experience, a friend of mine bought a new build house near Colchester in Essex, and within a year, essentially an enormous crack had developed through the house, and the two sides of the house were separating, and they hadn't done the foundations properly, and he needed to move out as they rebuilt the entire house, which would seem a fairly basic error. Anyway, and if we move on to the next chart, Richard, the bottom line from these charts is do not buy new build homes, because you initially pay a premium. So this shows the price of a new build house or flat relative to the market. And it shows that initially you pay a premium, which can be very substantial, but then over time, those new build properties move to a discount to the market, and the numbers can be really quite stark. So on the left-hand chart, new build houses in Leeds start at a premium to the market of about 15%, but then over the course of 20 years, move to a discount to the market of around 12%. And it's even worse for flats. Flats in Leeds start off at a premium to the market of about 5%, but then over the course of 20 years, move to a discount of 40%. So new build flats and homes are not a good investment.
They are. So in some senses, Keith, they follow a similar trend to new cars.
Yeah, true.
So Keith's conclusions is being great for property developers. They will suffer if it's not renewed in 2023, and that's a question mark over whether you want to own property developers now, I guess. And as an investment, new build homes are not a good plan.
Yes, and we get discussions of whether to buy new build flats off plan on our Discord channel, and it's clear the answer to that question is no. If you see a new build flat advertised, avoid.
So other charts. So this is we've talked about Chinese real estate problems at the moment, and this chart shows that the Chinese real estate bubble is the biggest one that we have had in modern history, larger than the Japanese one, and larger than the Spanish one, larger than the US, far larger than US, and it outstrips all of them. And the Spanish one was particularly egregious, and it's and hugely damaged the Spanish economy when it popped. And I think the Spanish economy is still suffering, the Spanish banking system is still suffering with the bad debt and so forth. And China is at nearly 30% of the country's GDP. A collapse in the property market would be a disaster.
But actually, before you move on, Richard, one thing I'd say about that chart is it starts in 1997. So it actually avoids the Japanese property bubble.
Yes, you're quite right. Chinese property developers continue to default on offshore bonds, which is part of the theme we've been discussing for the last few weeks. Nobody really knows what the outcome of the collapse of the Chinese property bubble, which I think is probably happening now. Nobody really knows what the long-term effect will be.
We will do more on this next week.
And this chart, which Keith found is very interesting, it shows the federal debt in blue and non-federal debt in red. And basically what's been happening over the past couple of years, 10 years probably, is that as US businesses have been deleveraging, the Fed has taken the strain by taking up the difference. And so we've had a transference from the private sector to central banking.
Yes, so basically the US government borrowing has allowed the private sector to deleverage, but now they are both re-leveraging.
Yes.
So that's good for GDP growth, but that means potentially a lot of money supply being pumped into the economy and could be inflationary. Just a reminder, the blue line is the US monetary base as a percentage of GDP, and it has been shooting up as a function of QE, and interest rates, as in the 3-month treasury rate, which is the orange line, are rock bottom. And if you believe that inflation is always a monetary phenomenon, as Milton Friedman would say, then that combination of rapidly growing monetary base and very low interest rates are, that is inflationary rocket fuel.
So inflation expectations continue to rise, and the question is, when will the rising rates start to affect the stock market? And if you remember, a few weeks ago we had a chart in which showed that stock markets like low levels of inflation, but when inflation gets, I think, Keith, from memory, around about 6%, stock markets cease to respond positively and start responding negatively to inflation rates. And Keith has a quote here he's put in from Jerome Powell.
Yeah, so essentially US 5-year inflation break-evens top 3% for the first time ever. And that prompted a statement from Jerome Powell, which it may be coincidence, but anyway, he then went on to say, the risks are clearly now to longer and more persistent bottlenecks, and thus to higher inflation. Supply constraints and elevated inflation are likely to last longer than previously expected and well into next year. And the same is true for pressure on wages. If we were to see a risk of inflation moving persistently higher, we would certainly use our tools, he says.
By which presumably he means a spanner and a screwdriver, because I don't think they have any other tools, do they, Keith?
No, the tool is, Richard, talking the market down,
yes.
Of which this is great evidence, and it worked. The 5-year inflation break-evens actually dropped immediately after his statement. So expect more of the same, but don't expect any action. Now, I thought this was a great chart because it shows the cause of the supply chain bottlenecks and also the massive rise in commodity inflation, in that during the COVID disruption, where people were stuck at home, unable to go to the restaurant or consume services, but having their wages subsidized by the government, they spent on goods. And you'll see goods consumption has gone massively above trend. And so manufacturing has been sucking in commodities, and all the supply chain problems are caused by too many goods trying to move around the world, whereas service consumption remains below trend. And until those get back towards trend, you would expect supply chain disruptions to continue. And on that note, it would seem that suppliers' delivery times continue to deteriorate. So supply chain disruptions don't appear to be getting better. And the number of ships at anchor off California, Long Beach and Los Angeles continues to increase and has increased sharply in the last few weeks.
Yeah. There's no sign of it improving yet, is there, Keith? And global shipping rates possibly starting to fall, this chart shows. It runs from March until October, September, October. And so there's been a plateauing of these.
Yes. I should just say thank you to Leebod from our Discord channel for sending this chart, which are from China. So that's early days. Slow down in rates there. Now, I thought this is a very interesting chart because it shows the percentage of city office space currently in use in the US. And the bottom line is, although the economy is getting back to normal, people aren't going back to their offices. So that surely has to be bad for commercial property prices and for also restaurants and any of the service sectors that service office workers. If people are only coming into the office once or twice a week, then coffee shops, sandwich bars are not going to be doing well.
Now you can see this in London, Keith. If you walk down the road and at lunchtime in central London, a lot of commercial premises are now boarded up, which presumably were coffee shops, cafes, and so forth. And it looks rather sad and miserable. And there's a huge shift in the economies of cities.
Yeah,
city centres. 53% of US households don't have emergency savings.
Yeah, and actually what I found really amazing about this chart was the elderly. If you got to the age of 80 and you don't have an emergency savings account, you're in big trouble, surely. Thank you to Stuart Owen for sending us this chart, and it shows the assets under management of various asset managers, and private equity has grown absolutely enormously over the last 20 years, which is surprising because it's been known for a very long time that private equity is essentially just a geared play on small companies. And actually that can be replicated fairly easily. And the big advantage private equity have is they don't have to mark to market all the time, so which flatters their performance. Richard.
Yeah. And I think there are concerns that we are moving into a private equity bubble at the moment, aren't there, Keith? Because their returns do appear to be favourable in comparison to other investments, some other investments. And as you say, rightly say, a lot of it is based upon the ability to leverage hugely. And if interest rates go up, the ability to leverage will obviously decline, but also the leveraged investments that currently exist will also run into problems. So I suspect that private equity investments are not as stable as some people would have us believe.
Yes.
COVID. So Keith has popped these charts in, which show cases and deaths are soaring in Eastern Europe. And you've probably come across this in the news just generally, but this sort of really brings it home that if you look at the UK, that on the left-hand side, it's being the dotted line, daily cases per 100,000. And since July, we've been between 40 and 70,000 roughly. And these Eastern European countries have taken off exponentially since July. And then the daily deaths per million have done the same thing, which indicates to me that their vaccination rates must be much lower. And if you look at the UK's daily deaths, it's been stable probably since midsummer. So this is a serious source of concern for those Eastern European countries.
Drawing on what you have just said, Richard, essentially, these charts show the cases and deaths per, in the case of the blue lines, is cases per 100,000 people, and the red is deaths per 2 million, which is rather an odd statistic anyway. But what they show is that cases and deaths are rising rapidly in Eastern Europe in particular, where vaccination rates are incredibly low. So in Armenia, vaccination rates are 5.8%, and Romania, where cases are going through the roof, it's 30%. And it would seem that former communist countries have a very fundamental lack of trust in the government and are very vaccine wary.
What's fascinating about this chart, I think, Keith, is you couldn't ask for more clear evidence that vaccination works. And yet there are a significant number of people who are vaccine hesitants, as we call them, don't want to be vaccinated. And to me, I think it is incomprehensible that someone should not want to be vaccinated.
And now the format of this chart took me a little while to work out, but it's actually roughly in the shape of Europe. So what it shows is how you're getting massive increases in cases, primarily in Eastern Europe, Southeastern Europe.
Yeah, and Russia, of course, has got a problem, hasn't it? And in India and the US, the daily confirmed cases per million are falling. And India, as you know, had that very nasty spike, which has come right down, presumably because they've got their vaccination program well in hand now. And the United States daily cases per million also falling sharply, having risen sharply. I think what it also shows is the world is not out of COVID yet by any means.
No.
And if there's a variant that evolves that can get around our immune systems that have been strengthened against by vaccination, then we would be back to square one in many senses. So equity markets, Keith.
Okay, so it was generally a good week for equity markets yet again, and we are now moving into the fourth quarter, which is generally strong period for equity markets, and the FTSE was up 0.8%, Stocks Europe up 0.8%, S&P up 1%, Nasdaq up an astonishing 2.1%, and up 20% year to date. Japan was down 0.2%. Bitcoin, having had an extraordinary run, was down 2.7%, was up 110% year on year. Richard will be talking about that. And sterling was flat. Now, Tesla had an absolutely extraordinary week. And we have talked about Tesla before and how it is, seems massively overvalued on any traditional metric, but Tesla doesn't care. And this week, its market capitalization shot above $1 trillion on the back of, was it Hertz, doing a deal with Tesla to buy 150,000 cars?
So why is Tesla not valued like any other car company? Discuss.
Hope.
Yeah.
And essentially, it's Tesla is now got almost, the market cap of Tesla is almost the same as the market cap of all the other car companies in the world combined.
It is an example of the greater fool theory, isn't it? But and it will end badly. But I've been thinking it's going to end badly for some time now, and I've been wrong. Now, I haven't bought any, and I don't propose to buy any shares in Tesla. But inevitably, at some point, people are going to be left holding the baby, and it's going to be very unpleasant for them when it happens. But if they get out having at the right time, they will consolidate their profits, so realize their profits. So it's just,
well, the apparently the drive higher in the Tesla share price is caused by massive options buying. And so, you know, how much is that market manipulation? I mean, but still, people spent $5.1 billion on options on Tesla this week. There's absolutely amazing numbers.
Yeah. And as we know, the dealers, the market makers of options, when they sell a call option, when they write a call option, they go out and buy the underlying stock in order to protect their position. So if they're writing options because there's a market for them, they're buying the underlying stock, which forces the underlying stock price up, which becomes a self-fulfilling prophecy.
Yeah.
So the option holders sell their options, and then the reverse happens.
Well, like Richard, I've been deeply skeptical about Tesla. In fact, all the tech companies for a very, very long time now. But once again, we remain hopeful that the tech bubble will eventually burst. And this chart shows how different sections of the market performed after the dot-com bubble burst in March 2000. And the bottom line is companies with real earnings did okay.
Yeah, indeed. And of course, Keith, the other reason why we hope it bursts is because we haven't invested in it. And if we had, our portfolios would be up 22.2% this year. Yeah. And they're not. Well, mine isn't anyway.
Obviously. Now, this is a really interesting chart. And this shows the performance of the 25,300 stocks listed in the US between 1926 and 2016. And on the y-axis is the number of companies. And on the x-axis was the total return provided by those companies over their lifetime. So that spike, 3,100 companies at -1, those are companies that provided precisely zero return over their lifetime on the stock market and before they went bust. So you got a return of exactly -100%. And what this chart shows is that the wealth creation on the stock market is concentrated in just a few companies. So 4% of companies created wealth, essentially. 5 companies in total, so I think that's Exxon, Apple, and a few others, responsible for 10% of total wealth creation. So what you're on the lookout for is the small number of companies that are actually creating value. And what this says really is the reason behind the momentum. Stocks that are doing well, there are very few companies that actually create real earnings, real wealth. And if a company is doing badly, get out.
It also means, Keith, that if you are a long-term buy and hold investor, which is what I try to be, you have to be really, really good at stock picking.
Yes.
Or have an effective system of getting out of the losers. Although having said that, this is this chart is path independent. In other words, had you bought, I don't know if Amazon is in it, but as an example, had you bought Amazon before the tech crash, you would have suffered a huge drawdown, and you would have had to have held it through that in order to have benefited from the subsequent price rises. So it's a difficult strategy to follow, and this is just one element of following the strategy.
Well, I'm very taken by your rule, Richard, that if something goes down 20%, you sell it. I think that's a good discipline to have.
Yeah, or try to sell it.
Yes, well, so this is just a reminder that seasonality now starts to kick in as stock markets traditionally have a very good run up towards Christmas.
But
although there are quite a few blow-ups in Q4, although I would say most of them seem to happen in October, and we are now out of October. So clear run into Christmas.
Good news. Flows into equity remaining very strong, despite the fact that equity markets, or maybe because equity markets are highly valued.
Yeah.
Since the asset prices reflect the flows, assuming it's new cash, and profit margin expectations, as we have talked about previously, are very high, and at some point, profit margins. And we talk about the fact that the US has a lot of monopolistic and oligopolistic behavior, and of course that facilitates increasing margins, which is why companies go for it. And US competition law has been slowly undermined over the last 50 years. And the question here, I suppose, is US competition law going to become stronger or be applied more strongly and diminish the amount of oligopolistic behavior, thereby reducing operating margins? What do you think, Keith?
Well, Biden is explicitly said that they've appointed somebody to the petition authority who is actually intending to do something. We will see. But also these rising margins assume that you can pass on all the price pressures to consumers, and also that these wage price growth can be passed on. I just don't think that's possible. There's a fallacy of composition there, because as you try and pass wage growth on through higher prices, then workers are going to demand higher wages, etc., etc. I just don't think it works. So the profit margins are subject to mean reversion. They're very high, and I'd expect them to start coming down. And on that note, yeah, surprising to the downside. So that suggests actually that companies are being unable to pass on their wage.
Quite interesting to see that Tesla's in there, Keith.
Oh.
This is a chart of Ether. It's very similar to last week's chart, really. They've had a bit of a pop this week. There's a lot of discussion over the effect that the Bitcoin ETF is going to have on the Bitcoin price, and basically I'm holding on to my Ether, waiting for the price to go up significantly, and we shall see. Bitcoin, it hasn't really been no movement now for 6 months in the price, and the ETF hasn't resulted in a huge spike in the price, which I think some people thought it would do. So I think there's a futures market in Bitcoin, which if it acts in the same way as the futures market does in gold, it will actually serve to depress the price of Bitcoin, or to enable the prices to be more easily manipulated by the writing of futures contracts. So I'm not entirely convinced that an ETF that uses futures is actually as it purports to be. So a couple of little headlines from the Financial Times today. So the US regulators targeting DeFi with global standards, so moving to the cryptocurrencies. So there's more and more regulation coming into, or regulators trying to get more and more into the crypto markets. And obviously central banks are fearful that they don't want their role to be undermined by currencies over which they have no control. And traders bet on Ethereum price surge from mooted ETF approval in 2022. So again, sort of speculative froth around these things. So be very careful. Have just a small fraction of your net worth in them, I think, would be my advice. Not that we give advice here.
Yeah. But one thing I'll say, Richard, is I have actually, as somebody who doesn't hold any Bitcoin and is very skeptical, obviously, I've been very impressed by how resilient Bitcoin has been to the Chinese regulation. Essentially, you've removed a huge chunk of previous demand by the Chinese regulators banning it, essentially, and Bitcoin has been hasn't collapsed, so it's actually gone up strongly. So yeah, I'm impressed.
Industrial commodities. So we've got a lot of commodities on this chart, so we're just going to pick out a few highlights, and then we'll go through the graphs. So aluminium down 9.7% on the week, although up 36% year to date. And lithium up nearly 6% and over 300% year to date. Neodymium up 14%, 165% year to date. Nickel and tin both had rather bad weeks. Natural gas, having had those enormous spikes, has dropped by 12.6%, but has still tripled over the year. Coal dropped back a little bit, but has nearly doubled over the year. And uranium seems to have sort of found a settling point at the moment, at around about that sort of 47, 48 pounds per dollars per pound. Anything you want to add on that, Keith, before we go on to the charts?
The only thing I'd add is the aluminium, which had a bad week. I strongly suspect the demand for aluminium has fallen because of magnesium shortages. Now, we talked about that last week, but magnesium has over twice the energy intensity of aluminium, and the Chinese have ordered loads of magnesium smelters to halve their production. And essentially, magnesium is an essential component of aluminium composites because it strengthens aluminium. If you can't get hold of the magnesium, then you can't produce your strengthened aluminium. So
there's another argument for actually creating far broader supply chains and for countries not to be totally reliant on production in China. Now, I know that's happened because of cost pressures, but there needs to be some strategy put in place by governments such that we don't enable the displacement of businesses in countries by undercutting through from a single subsidized supplier. And I think that's probably quite a difficult one to address in practical terms. but it needs to be addressed. We need to have far more resilience in these production plants and supply chains than we currently have in the world if we're not going to suffer this type of problem again. So this is the commodities most negatively exposed to certain energy prices, i.e. what's the energy input to manufacturing these, to producing these commodities. And as you can see, as we've discussed before, aluminium hugely energy dependent. And it's interesting to see, you can't really avoid it, can you? Basically, you go metals, paper, industrial gases, basic chemicals, cement and glass, you know, and fertilizer.
Yeah, and it's no coincidence that aluminium and fertilizer prices have gone through the roof as energy prices have gone up, basically, and China has started rationing them, essentially. When we go on to my own portfolio's personal performance this week, you'll see it was very poor. On the back of, I hold some energy service companies, and my calculation was that as the oil price rose, so CapEx would return. And the bottom line is it ain't. And this chart just shows that. So far,
it also shows that there is not going to be any increase in production levels. And if demand stays where it is, prices will continue to rise. Crude oil had a reasonable week. It is settled around about the $80 to $84 a barrel at the moment. It hasn't really shifted for 4 weeks or so, I think. Keith, has it?
Yeah. Well, it's been up over 4 weeks, but it was flat on the week, basically, flat to uppish. Yeah. Now, this chart shows that commodity and material stocks represent only about 5% of the S&P 500, and these numbers are as of the 30th of September 2021. And you'll see the bottom dark blue wedge is energy. That's currently 3% of the S&P, and the bar above it is materials, and that's only 2%. So potentially, if the markets rebalance, then commodity stocks could have a long way to go. Oil companies are forecast to make the most money they've made in 13 years this quarter. Although we had quarterly numbers from Shell this week, and although it made record free cash flow, its earnings were down 25% on Q2 due to various impairments. And you'll be unsurprised to learn that ESG funds are heavily underweight the energy sector. And so are traditional active managers, although they seem to be buying more now. So this chart shows the relative weighting of energy in active managers' portfolio relative to the index. And you can see they're all underweight, but that the level of underweighting has been reducing in recent months.
Which hopefully will transmit into a gentle increase in price. Who emits the most CO2? So Keith found this fascinating chart. So China emits the most CO2 and is enormous. I'm looking just on interpreting this graph, at least twice the emissions of the United States, which is the world's second largest emitter. And India is probably about the fifth of the emissions of China. What this, of course, means is that China isn't joining COP26. And if China doesn't try and reduce its global emissions, then the efforts of the rest of the world are severely undermined. And of course, China is the source of a lot of the products the rest of the world uses. So it's not like it's all down to the Chinese. We are using high carbon products produced in China.
Absolutely. I should say that chart is from 2017. And since then, China's built a hell of a lot more coal stations, coal power stations.
And that's CO2 emissions per capita for the G20 countries. And Keith and I were contemplating that maybe this is due to air conditioning systems, because hot countries appear to be highly represented in here, not all of them. And the UK is right down at only 5, whatever the unit of measurement is.
Yeah.
as opposed to Saudi Arabia, which is 3 times as much, 15, 17.
Yes. You also notice how well France is doing from all its nuclear power stations.
Yeah, yeah. And India is surprisingly low, actually, but I guess they have a low GDP per capita as well.
Okay, so this shows why oil prices are going through the roof. The yellow line is global oil consumption, which has recovered strongly, although it is still substantially below its pre-COVID levels. But oil production has lagged, and there's a big gap between the two, and that is coming out of inventories, which are falling. But if we move on to the next chart, this is from the EIA and is their forecast for demand and production over the next year. And you'll see there is this unexplained jump in global production, and global consumption is going to keep on rising. So how much do we believe these production forecasts? That jump seems extraordinary. The market believes that the supply demand in the oil market will come back into balance in 22-23, and so you're getting backwardation where the spot oil price is substantially higher than oil prices later on in 22-23. Seasonality, the oil price actually has a different pattern to equity markets in that the oil price tends to fall in Q4, whereas obviously equity markets tend to rise. So you could well see price weakness from here. I'm afraid everyone hates fossil fuels, but they don't like the consequences of not having them.
And I'll go through the price charts. So aluminium showing its fairly dramatic fall from its peak. Cobalt, copper still in its range. Chromium still moving up rapidly.
Yeah, Rich and I remain mystified by the cobalt chart.
Chromium
So
chart.
the chromium chart.
Yeah. Iron ore seems to have found a bottom. We'll see whether it sticks to that level. Lithium continuing to price continuing to rise as battery demand. Neodymium presumably price rising because of magnets in cars, car electric motors and wind turbines. Nickel has come back a bit, but it's fairly stable at that sort of price level. And a chart that's showing nickel inventories are falling fast. And if that is reflective of global supply, then one would expect to see the price start to pick up again. Tin, I would say, Keith, that the sort of the continuous and collective rise in commodity prices that we had been seeing seems to have stopped now and become more idiosyncratic, depending upon the individual commodity. Would you think?
I think that's probably true. Yeah, but I mean they've all had an extraordinary year.
Yeah, and ferrovanadium just picking up a little bit there. Natural gas futures dropped back, and I think Russia has made some emollient noises recently about increasing supply to European storage, and that I think has had an effect on the market. It was due a pullback.
Well, I think they've made their point, Richard.
Yes.
Frankly, they are in charge, and Gazprom, Putin has said that Gazprom will start refilling European storage from the 1st of November.
Price of coal has come back a bit. I think this week the Chinese government has capped the price of coal, and of course, a communist country, they can basically tell their miners to cap any price they like. But what it doesn't do is it doesn't change the supply-demand dynamic. So it might cap the price of coal in China, but if they need to import coal, then the market price of coal will be set by the price and demand. So I think it might have been responsible for some of the downturn in the price of coal, but there is still a supply-demand imbalance.
Yeah, so this is coal stocks in the US. And obviously the rest of the world, and particularly Europe, have had these enormous energy spikes as in Europe, natural gas inventories have dropped, and we're worried about a cold winter due to La Nina. And elsewhere in the world, in China, you've had massive rises in electricity prices because of shortage of coal. Well, the same could well be true of the US. And what this chart shows is that coal stocks are low and below their 5-year range. So far, coal and gas prices in the US have not joined the massive spikes you've seen elsewhere in the world, and that could be starting to change, perhaps.
So the price of uranium spiked up, dropped down, and has come back up, and I think we just have to wait and see what happens, although I'm still relatively bullish on uranium in the long term, because I think nuclear power is the way the world will go to resolve the conflict between fossil fuels and requiring our energy levels to be maintained. And on to precious metals, Keith.
Well, it was a mixed week. Gold was up 0.4%. Silver, which had a good week last week, came off 1.3%. The rest of the PGMs continued to fall. Platinum 4.2%, rhodium up 0.7%, palladium down 2.4%. But if you look at the year to date, it's been very poor.
Yeah, the gold has gone nowhere now for quite a few months. Silver, if we had a longer term graph, this would be in a range. Platinum doesn't look particularly strong. Looks like it might be going down, heading for another downturn now. Rhodium settled back down, having doubled and then halved.
Yeah.
And palladium has done something very similar, really, to rhodium.
One thing I'd say on those, Richard, is that the PGMs are all obviously mainly used in catalysts. And when you've seen essentially a 50% drop in UK car manufacturing year on year due to the supply chain disruptions, then of course the demand for PGMs is going to be depressed until car manufacturing gets back to normal.
It is. But of course, all the while it's depressed, time is passing and we're moving towards more and more electric vehicles and further away from fossil fuel vehicles. So it does make you wonder, if you sort of integrate under the line of demand, it does make you wonder what total demand is over, say, the next 5 or 8 years. Yields and rates, Keith.
Well, it was an extraordinary week, frankly. The yields on UK government debt fell across the board when the UK government revised down its borrowing expectations for the coming years. And so that suggests that the markets were actually more concerned about the solvency of the UK government in the form of debt issuance than they were about the outlook for inflation. And the rise in UK government bond prices actually caused rises in government bonds around the world, including in the US, which suggests that there was a general concern about the level of issuance as opposed to what we're concerned about on this podcast, which is inflation. So I was very surprised because these are big moves. So on the week, the 30-year dropped from 1.44% last week to 1.11%. I mean, that is an enormous drop. But elsewhere in Europe, the bond yields and the periphery did not fall. They actually rose on the week and rose quite substantially, which I found quite interesting. So the Greek 10-year rose 5 basis points on the week to well above 1%. So interesting. Watch this space.
Yeah.
Now, next week, we are going to talk about the yield curve. But just to show here that the yield curve is flattening, which suggests that people are more concerned about short-term inflation than long-term inflation. And we will leave it there and talk more about it next week. And the big change recently is that suddenly the market is starting to price in rate rises. So central banks have started to tighten, and markets are concerned that essentially they're going to tighten too much and kill the recovery. But if we look at real yields, and the white line here is the US 10-year real yield, they are heading right back down to their lows. And frankly, I think those numbers are too low, because I mean, we have in the US yields are 1%, and we've got inflation of 5 or 6%. So they've got very strong negative real yields.
Yeah. But
so far, as predicted, it's been a very poor year for bonds. So the US 10-year has had one of its worst years in history. Unsurprisingly, investors are very negative on bonds. So this is the allocation of institutions, private clients, and households to bonds. And you'll see they're all very low. So
who's buying them, Keith?
Well, I'm not sure. It must be the Fed.
Oh, and the Fed is expected to start tapering in December. But just going back to this chart, you know, there seems to be an inherent contradiction in that, doesn't there? And I suspect that they will find they can't taper. They may have a go. I suspect they'll find they can't taper.
So this was the UK 10-year, and you can see it mystifyingly, the yield dropped as the UK announced it was going to borrow less than anticipated, although inflation, which you would think would be the main driver of gilt yields, remains very high. And that drop in the UK 10-year caused a drop on US yields as well.
And from a seasonality point of view, Keith, we are coming into, as we said earlier, that the sprint to the year end.
Yep. So hold on to your hats. Okay. So what was your activity this week, Richard?
Thank you, Keith. I had another quiet week. So no purchases, no sales. My weekly change, I was down 0.4%, which puts my change for the year at 11.6 versus 12.8 for the all share. I am sitting on my hands. I'm comfortable with my allocation, famous last words, and I'm sitting on my hands. And like you, I'm slightly frustrated that my commodity investments aren't translating into share price gains for the companies. And I think that is because there's some hesitancy on the part of many participants that these price rate increases are temporary and not more permanent. I thought I'd just put in one chart, Ivanhoe Mines, which is my sort of copper, my main copper play. And I just thought it was quite interesting to look at what it's doing. It was in a sideways range for quite a long time. It went out of the range. It sort of pulled back inside the range, and then it's following this trend higher now, and it's bouncing off the trend line. It went through the trend line here onto the 50-day moving average, and now it's back above the trend line. Now, I know that is also like, yes, it fits historically, doesn't it? What's it going to do in the future, Richard? I don't know. But if you, I like using simple charts. It suggests to me that Ivanhoe Mines is possibly consolidating and going to go higher. So what's my takeaway from that? I'm comfortable holding it, is my takeaway from that. And that's, just wanted to just give a little bit of the thought process, simple thought process that I might do when I'm looking at one of my companies. And that was all I wanted to say this week, Keith.
I should say that I'm in Crete this week, so Richard is driving all the charts. Well, I had a proper stinker this week and very frustrating. So I was down 2.6%. And having for a few weeks been well ahead of the all share, I'm now up 11%, which frankly, I'm still very happy with, although I'm now below the all share. And I only didn't have any sales, and I had one buy, which was Gulf Marine Services, which is a company with, frankly, an unhappy history. It has had too much debt going into the last oil downturn, and it rents out jack-up rigs. And it's now got its balance sheet in better order, and it had a rights issue earlier in the year, which I participated in, and the market is recovering strongly, so I have added more. And we look at the next chart. Okay, this chart is the cause, one of the main causes of my bad performance this week. So earlier we talked about the market for oil services, and I have bought various oil service companies in the expectation that a rising oil price would lead to higher capex. And sadly, that just hasn't been true so far. So we did a share talk on James Fisher & Sons, which is a diversified marine services company. And during the week, it issued a total doozy of a profits warning, in that actually the numbers in the profits warning weren't that bad. So from my calculation, we're talking about revenues only down between 3 and 5%, and earnings down around 10%. But the tone of the profits warning was relentlessly negative, and the market took that really badly. And as a result, the share price has fallen by 50%. That's 50% in a week. Now, that James Fisher & Son was actually a fairly substantial holding for me. I have about 1.5%. And so, that is quite a big hit to the portfolio, sadly. Now, I haven't sold because I think that it's now oversold now. And actually, I'll probably be looking to buy, but when it's found a bottom and
when they issue some good news, Keith.
Precisely. Okay, so moving on. So this is, of course, another company that's exposed to the offshore sector, Tecmar, which had a profits warning last week, which we covered. Next one. And this is a company which we did a share talk on as well, Hunting, which does drilling technology, and is heavily exposed to US shale. And it also had results this week, and results were also disappointing, and it has been a disappointing investment. But like the others, I remain very, very positive. And this is Gulp Marine Services, which is another oil services company. But unlike the other two, its share price has actually been ticking up a bit after the rights issue, and I have bought more. And this is another oil services company, Lamprell, whose share price is up 10% today, because like Gulf Marine Services, they have a very stretched balance sheet. And today they did a share placing at 32p, which the market took very well. And it looks like they're cleaning up the balance sheet, and they are moving into making offshore bits for the offshore wind farms. And finally, Shell, which had its Q3 results this week, and amazingly, despite the rise in the oil price and the gas price, it managed to make less money than it did in Q2 due to various impairments. And I'm not really sure how they managed to do that. I'll have to dig in further. So as a result, share price was off something like 5% in the last couple of weeks. And that is the malaise of my portfolio. essentially.
Well, thank you for updating us, Keith. I'm sure that once exploration picks up again, your oil services companies will fly. It's just a question of holding on.
Well, absolutely. So thank you all for listening. I am in Crete and on holiday this week, so we will be back to usual next week. In the meantime, please can you press like and subscribe to the channel, and it is goodbye from Richard Wheaton.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.